I'm Jill Noonan, Senior Content Director at The Real Deal, and I'm here with Senior Reporter Konrad Putzier to talk about this month's cover story, which was on real estate's venture capital gold rush. Welcome, Konrad.
Thanks for having me.
So I just want to start with sort of like the lay of the land in terms of real estate startups. What sort of changed in the last 5 or 6 years?
It's really interesting. There was this big change that happened behind the scenes, which is something we've never really written about. Very few people have actually written about. People obviously notice it. But a couple of years ago, there were a lot of real estate tech startups who just had a hard time raising money. Now, fast forward a couple of years, 2018, all of a sudden it changed completely, and everyone is basically swimming in money. Everyone's getting hundreds of millions of dollars thrown at them. I mean, I'm exaggerating, but if you think about it, there's companies like SoftBank now, which funded WeWork to the tune of billions, and there's so many more examples where now all of a sudden, all these venture capital companies have realized, wait a moment, real estate tech is actually a really interesting space where you can make a lot of money. And now sort of the floodgates have opened and all the money is just pouring in.
So how much money are we talking about?
So in 2012, the total investment in US real estate tech was less than 50 million across the country, which is nothing, right? And last year, 2017, it was more than 5 billion.
So what do you think is sort of responsible for this great awakening? Why have the floodgates opened?
I think there's a couple things going on. One is just it took a while for commercial real estate tech to become like a real thing. It takes a while for companies to grow and to basically get in that position where they're big enough and potentially successful enough to raise a lot of money, right? 5 years ago, there just weren't as many startups that were in a position to raise $500 million or $1 billion. Another thing that changed is, I think, people look at companies like WeWork and Airbnb, which are basically real estate startups, and see the valuations that they've gotten, and they think, wait a moment, if WeWork gets that big and they're a real estate company, how many other real estate companies are out there that could also become a $20 billion or a $30 billion company?
And so it's created this sort of sense of urgency and a snowball effect in a way.
Yeah, and since you mentioned the snowball effect, that's like another side to this. If you're a venture capitalist and you invest in an early stage company, you're not just betting that this company will be successful, you're also betting that someone else, another venture investor, will come in later and buy you out at a bigger valuation, and that's how you make your profit. And at the beginning, a lot of people just wouldn't invest. They might think a startup is promising, they might think this startup will be very successful, but they just don't have the confidence that other investors are out there to buy them out. There just weren't enough people investing in real estate tech. So once you reach that critical mass, where you have a lot of venture investors getting into real estate tech, people are more comfortable investing because they can be confident that someone else will buy them out at a higher valuation. And that's sort of the snowball effect.
Obviously, you already mentioned SoftBank, but who are some of the other players that we're seeing sort of rush into the space?
There's companies like SoftBank, Sequoia Capital. There's a big established venture capital companies that are now getting into real estate tech in a big way. SoftBank obviously has invested in WeWork. They committed more than $4 billion last year. They committed another $1 billion. They've also backed companies like Compass. So those are sort of this one group, right? The traditional venture capital companies. Then we have a second group, which is completely new, venture capital companies that specialize in real estate tech. So Fifth Wall Ventures is one of them.
And they're currently raising a $400 million fund, right?
Yeah, they seem to be constantly raising for new funds. There's clearly a lot of interest in them. There's a couple of others. There's Metaprop, it started off as an accelerator, which now has its own venture capital fund. There's Navitas. There's a couple of others that basically have decided there's so much interest now among investors to invest in real estate tech that we're just going to launch a real estate tech specific investment fund.
And how do you think the investments that they're making differ from the investments that the bigger, more traditional VC funds are making?
Mm-hmm. I mean, fundamentally, it's the same thing. You invest in a startup and you hope that the startup will be successful and that you make a multiple in your investment, that you make a huge profit. I think the one difference is that these real estate specific companies are often what is called a strategic investor. So the way it works is Fifth Wall Ventures goes out to real estate companies like Lennar, any major real estate company, and get them to invest in their real estate funds. Then they use that money to fund startups. And the idea is just the startups not only get money from Fifth Wall, they also get the expertise from all these real estate companies that invest in Fifth Wall.
And Fifth Wall just recently did that with Open Door, right?
Yeah, so that's just one of many examples of Fifth Wall sort of basically helping the companies grow, not just by giving them money, but also by opening up partnerships with their own investors.
And tell us about the third category.
If the first category is traditional venture capital companies, the second category is sort of real estate tech specific VC funds. The third category is real estate family companies that just invest their own money. And there's plenty of them. There's the Lafrac family, which has Lafrac Ventures, the Milstein family, Rudin family has Rudin Ventures. There's just so many real estate family offices nowadays that basically decided they use all these tech products all the time. If they use them, why not just also invest in them? Because if you think something's good, if you think something is useful, you might as well benefit from the upside.
Right, and that is like RXR is doing that right now.
Yeah, so there's a big difference between what RXR does and what some other companies do. So like Rudin Ventures, for example, they have, they make venture investments, but they don't have a specific investment vehicle that like pools third-party money and invests it in startups. They also don't have like a big staff or anything. It's really just the Rudin family invests in tech startups that they're familiar with. RXR, on the other hand, they actually launched an investment fund. So rather than Scott Reckless saying, I'm going to invest my family money in tech companies, he decided, I'm going to launch an investment fund that raises money from third parties and then invest that money into startups.
Let's talk about some of the challenges that these startups are facing just by accepting this money. I thought one of the really interesting quotes that you had in the piece was that this is like some of the most expensive money out there, so just get ready to sort of swallow that going in.
I think that's the important thing to always keep in mind, and that's something that startups grapple with, is that venture capital is very expensive. Because generally, if you want to raise a lot of money through venture capital, you have to usually give up a big stake in your company, a big portion of the equity, whatever it is specifically, and then these investors then expect a multiple on their investment. They generally expect you to grow very quickly, and they expect to make a huge profit. So those two things combined mean that if you raise venture capital, it's not cheap. There's a price to pay, and I think the criticism I've heard of the model is often. There's some people who say that venture capital as a model often isn't right for real estate tech because there's so many real estate companies that just need a lot of money, whether it's because they have to buy their own buildings, build out their own spaces, lease spaces. There's a lot of like real estate related capital investments that have to be made. And if you use venture capital to pay for all that, it's just a very expensive source of funding.
Whereas like in the past, or not in the past, but just generally VC funds have often invested in companies that are not sort of like burning through as much cash because they don't have the same sort of overhead.
Yeah, like if you look at an example, Airbnb, right, which is a real estate company that's raised a lot of money, they're a software platform. They don't typically lease their own buildings, they don't build out spaces, they're purely like a software platform. So if they raise venture capital, they can use that for marketing, they can use that for hiring, they can use that to build out their technology. They don't need to spend that money to like buy or build buildings. So venture capital, some sources say, is great for that kind of model. If you're more like a WeWork or like an Industrious and you have to, you buy your own buildings, you lease your own buildings, you spend money building it out, venture capital might still be good for you, you might still want to raise it, but, according to some sources, there is a potential to maybe think about other sources of capital, like raising debt, like a more patient type of private equity structure that just doesn't have these like fast growth demands.
Do you see sort of an oversaturation in VC money going forward?
I haven't talked to anyone who actually thinks that there's too much venture capital in real estate tech. So the consensus is basically real estate is such a huge industry. It has so little technology if you compare it to other industries like finance. So there's still such a huge need for tech startups to change the space, and there's still such a huge need and demand for funding. So the consensus is basically no. In aggregate, there's not too much money going into real estate. Tech, on the contrary, we can use even more money. I think, obviously, there's some startups that people think are overvalued, and that's always going to be the case. There's going to be investors that lose a lot of money. There might even be a bubble that pops, who knows? But, in the big picture is there's not too much money going into real estate.
Yeah. One of my favorite quotes from the piece was about how there's not a whiteboard in Silicon Valley that doesn't have real estate tech written on it.
Right, yeah. Everyone wants to get in now.
Well, thank you so much for joining us. This was really insightful.
Thanks for having me.